Hey everybody, Marty Mazur. Good afternoon, 14th of December 2016. Yesterday I promised you that I would offer up some commentary if the market got squirrely after the Fed release. So I'm going to do this as quickly as I can. This is my one chance to do it. And rather than prepare slides, I didn't have a chance to do that. I'm just going to look at some charts and comment on them for you as we go. You're looking at the S&P 500 just today. There's where the decision was released, quarter point increase. We talked about that. That was basically 100% probability was baked into Fed funds futures. You see the market actually did okay for a little bit. Then the commentary started. Apparently Janet Yellen suggested, hey, maybe there'll be 3 rate hikes next year. The market was expecting her to say 2. So the market reacted to that. You can see it was kind of all over the place. We should never make a whole lot of one day's action. This market was, as I suggested yesterday, was quite a bit overbought. You tend to get dips, sideways moves, and so forth. You can't really even call any more 100-point move in the Dow much of a dip, I guess you could say, on a one-day basis. But I offered up a chart the other day that talked about how at 20,000 you really need a 200-point dip to really call it a decent dip, if you will. So again, the prospects for higher interest rates next year, what does that mean? Well, I have shown you many charts over the last few months that suggest that that's not a bad thing for stocks, as long as the backdrop is an accelerating economy. And that appears to be the backdrop that we have right now. And quite frankly, my indicators suggest that it should be 3, if not more, Fed rate increases next year. And history suggests we shouldn't really worry too much about the stock market in that environment. Now, certainly volatility like today, but this was not much, even in terms of volatility relative to the norm. It's just something we haven't been experiencing since whenever the election was, early November. In fact, I think Janet Yellen could have been even a little more aggressive on the economy and said, you know, we've been needing some fiscal reform. Maybe we're going to get it. Maybe that would be a good thing, and maybe the economy will run hotter. And maybe in some respects that'll be good. And maybe we'll be able to get some of the things we've been looking to get. And one of those would be a little bit of inflation. And that actually is beginning to show up in my preliminary indicators. So we'll see how that plays out. But it was a day when, as you would expect, interest rate sensitive things would have taken a hit, like bonds. Here's TLT, which is a 20-year Treasury Index ETF. What a hit that took today. Utilities, we have a 0 target to bonds, 0 target to utilities, and 0 target to real estate investment trusts. Thank goodness today, anyway. Not that the other stuff we own had a good day, mind you. And here is what REITs did today as well. So not a good day if you're interest rate sensitive. But what about financials? Financials are supposed to be interest rate sensitive in a good way. Well, they even took a hit. Wasn't as big a hit. It was about 0.5% from the opening. You can see they were rallying pretty good until the meeting. So from there, that was, had to be more than, that looks like about a 2% move from the peak, but for the day it was about a 0.5% move. That would be in sympathy, I think, with the rest of the market. A backdrop of a better economy with higher interest rates, as long as they're just not exploding higher, which they're not, should be pretty good for financials. So this tells us that today's market was a reaction, if indeed stuff that should have done well didn't. It'll be interesting to see what kind of a bounce back, if any, we get in these. Like, for example, let me just see in the after hours how financials were trading. Up just a smidge, 0.04% in terms of the overall market. If the Dow were to open right now, it would be up about 53 points. Like I said yesterday, these dips tend to get bought. I don't know that this one is going to get bought when we wake up in the morning tomorrow, but really nothing has changed. I think the Fed has just acknowledged that things are looking better than they have in quite some time. And I think they should be very comfortable with today's Fed increase. And right now, with the data we have at our disposal, you and I ought to be comfortable with that too. And quite frankly, we ought to be comfortable with the prospects of the market giving something back relative to this rally that it's had. And whether it happens between now and the end of the year or into January, which can be a pretty volatile month, really doesn't matter for us long-term investors. So folks, again, I bothered you today for a few minutes because I promised I would, and I'll just leave it there and wish you a good rest of the day. If I'm not back between now and Friday or Saturday, that's when you'll get my weekly message. Take care. Thanks again. Bye-bye.